Hello, this is William Mbuta. Allow me to present to you Mr. Dave Stragnall, Head of Actuarial as well as UCT Retirement Fund Trustee. He will be presenting on UCT provision for retirement fund savings.
Morning everyone, my name is Dave Stragnall. I'm the Academics Union nominee to the Board of Trustees, and I'm going to be doing most of the talking this morning, but I should acknowledge up front that the bulk of the content in this presentation is thanks to the hard work and expertise of the fund's principal officer, Olivia van der Hoeven, who many of you will have come into contact with already. Our aim for the talk today is really to address what we imagine to be the questions of the two broad groupings that sit before us today. And I understand that you fall into one of two camps. Either you have a few years to go until retirement, in which case you have some important decisions and choices to make, or you are right at the sharp end and due to retire at the end of this year, in which case, once again, obviously there are some very important choices that you have to make and have to make quite soon. So I'm going to be addressing what I see as the most important issues for each of those two camps. In talking about the issues confronting those due to retire this year, I will inevitably be revisiting the question of living versus life annuities, which Hugh has very capably introduced. I'll do my very best not to labour the point, but you may find there's a little bit of repetition. I think those points are worth repeating. This is perhaps the most important financial decision you're going to make in the rest of your life. So very important that we get all of the information across. The aim here is really to give you all of the information you need to make an informed decision about what choices you should make, about whether you need financial advice, about how to seek out that financial advice, so that you have the best chance possible of retiring with an income that is going to meet your needs. And that question of retirement adequacy and of the failure of most fund members to achieve the goal of retirement savings adequacy is one that exercises the mind of this Board of Trustees frequently, and indeed I imagine every Board of Trustees in South Africa. So I would like to start with a plea for you to participate in a piece of research which is being conducted at the moment by a PhD student. You should all have received an email invitation to participate in this over the course of the last week or so. But this research is looking very specifically at the question of retirement adequacy. So by taking the 10 or 15 minutes that it will consume of your time to participate in that survey, you'll not only be contributing to research and the development of knowledge, which is obviously one of the primary aims of the institution to which we all belong, but also hopefully contributing to some information that will help the trustees to make decisions about how information is communicated to members, about the choices that are offered to members, and hopefully to improve the lot of those in future generations. So please, if you can spare 15 minutes, do take the time to participate in that survey. And I'm hoping that at the end of this, we will have plenty of space for you to ask all the questions that you have. But please feel free, if there are burning questions that require immediate answers, feel free to interrupt me at any time and ask those questions. So just to start with a bit of repetition and context, the UCTRF is a defined contribution fund. What that means is that the amount of money that is available at retirement for you to secure a retirement income is going to be a function of the contributions that have been paid into the fund and the investment returns that have been earned on those contributions. There are no underlying guarantees from the fund as to the level of income that can be achieved. Okay? So that means that it's incredibly important that you make informed decisions about the amount that is saved in the retirement fund and the way in which that money is invested. So let me start with the kind of primary considerations for those who have a few years to go yet until retirement. You really need to be asking yourselves two big questions. The first of which is, how much do you have accumulated already? And that's a relatively easy question to answer. You can go to your last annual benefit statement, which will give you a static snapshot of how your retirement savings have accumulated. You can get a more up-to-date view on that by going to the UCTRF's website and following the link to the Sanlam Retirement Fund web. If you haven't yet registered, it'll just take a few minutes to register and to get a login. And you can get up-to-date account of how, pretty much a daily update of how your retirement fund balances are performing. That tells you where you're at. Obviously, a part of this, you want to get a sense of where you're likely to be at your intended retirement age. And for that purpose, the UCTRF website has a retirement calculator, which I hope most of you have had a chance to use already, but if you haven't, it's something that you really should get acquainted with. And in that retirement calculator, you will have the opportunity to enter personal information about yourself, when you intend to retire, what you have already accumulated, information that you would get from that retirement fund web, at what level you're currently saving, and in which funds you are invested, and the calculator will then produce a projection of where you're likely to be come retirement date. Important to remember, though, that that is just a projection. That's based on assumptions about what might pan out in the future, and there's considerable uncertainty about what might be involved in that. The more important question is how much are you going to need? And that, of course, is a much more difficult question to answer. But it's a very important one to ask, because without that context, you really have no basis to guide your decisions about how you're investing and how much you ought to be saving when you ought to be retiring. If you had early retirement in mind, having a sense of how much you're going to need, a realistic sense, may guide you towards considering a later retirement, perhaps retiring at 65 rather than 62 as you had planned. The retirement fund calculator is obviously an important source of guidance, so this will give you a projection of where you're likely to be, and also with some not so subtle color coding, red, green and orange lights give you a sense of how on track you are to achieving what your goals are likely to be. Another source for which the retirement fund calculator and any information that we give you is obviously not a substitute, is to seek out professional financial advice. And this is something that everybody ought to consider very seriously. So again, at the risk of laboring the point, if you are going to speak to a financial advisor, the bottom line is that you want to ensure that you're getting professional and impartial advice, right? That it is advice that is in your best interest. So you're going to need to go through a checklist to give you as much confidence as you can possibly have that you are indeed getting impartial advice from a financial advisor. So asking for referees, being able to talk to other clients of the advisor, ensuring that the advisor is indeed phase licensed and registered with the Financial Services Board, preferably that advisor has a CFP qualification as a certified financial planner, or has some equivalent professional qualification. The advantage of interacting with a certified financial planner is not only will they have passed a rigorous set of exams, but they'll also be subject to the ethical guidelines and code of conduct of the Financial Planning Institute, and will have to comply with continuing education requirements. Ask the question of whether that advisor is independent or affiliated to a particular product provider or providers, what relationships or networks they have with other players in the industry, and most importantly, be very clear how advice is being charged for, and that any costs and commissions are very clearly disclosed. Now, as you said earlier, you may very well prefer to pay for advice through commissions rather than on a fee-for-service basis. That may well be the case, and I certainly can't tell you which approach you ought to follow, but what I can and will tell you is the approach that I would choose to follow, and that is rather to pay an explicit fee for advice than to have that tied into commissions. And the reason for that is I strongly believe that if fees are explicit and transparent and paid directly, they're likely in the long run to be lower than fees that are indirect and subject to some degree of obscurity in terms of how they are disclosed. But that's not a philosophy that will necessarily work for everyone, but it is something that you need to think through for yourself. The UCT HR department and the UCT retirement fund in the form of the principal office are very much there to assist, but that will be in the form of the provision of information. We are not in a position to provide financial advice, okay? But we can give you the information that can assist in the advisory process. So the question that you'll be asking yourself is, have I saved enough in order to have a comfortable retirement? And you may, after considering those questions, perhaps after taking financial advice, conclude that indeed yes you have, that you are very much on track, in which case congratulations, but you are in a very small minority. If you're like most of us, you're going to conclude that no, I have not yet saved enough, and I need to think about ways in which I can enhance my expected retirement benefit. And there are various options that are available to you. One is to increase your deemed pensionable amount. So if, for example, you are currently on an 80% DPA, you could increase that to 90% or 100% in order to increase your savings. You can choose on a voluntary basis to make additional contributions to the fund. You can reconsider your investment choice, although there are some caveats that I'd like to talk about there. You have the ability to choose to reduce your levels of risk cover, the level of death and disability cover, well, just death cover, I think, is that right, Olivia, in the fund? And that would increase retirement savings, but obviously you'd want to do that in the knowledge that the risk cover that you retain is adequate to provide for your dependents in the event that you die before retirement. And if you were considering early retirement, you may want to reorient your goals towards retirement at 65 if you find that you're not, in fact, on track to achieve your goals. Changing your DPA is something that you can do every year as part of your annual cost of employment review. You can choose to increase or decrease it. You will note that decreases in parentheses here, and that's because I want to deliberately underemphasize that. I hope that most of you reconsidering your DPA will be thinking about increasing rather than decreasing it. Should you increase it, that is going to result in a higher contribution to the UCT retirement fund, which means more retirement savings. It also means an associated increase in your death cover and disability cover. If you want to achieve the increased retirement savings without necessarily increasing the risk cover, then hold your breath for one more slide, because additional contributions is the way to achieve that. Some technical caveats which I won't go into now, but if you want to increase your DPA such that it results in an excess over the maximum allowed by SARS, then that's something that they will, and that currently is 20%, but from next year will be the 27.5% that you referred to earlier. You can also choose to request additional contributions to be made, and there are a variety of choices, all of which can be chosen by the HR 152 form. The best bet, rather than trying to digest all of this now, is if you come to the conclusion that additional contributions should be made, to schedule an appointment with an HR advisor or the UCTRF principal officer to discuss what would be best in your particular case. The key thing about these additional contributions is that, in general, provided you haven't exceeded one of the caps set by SARS, the additional contributions are on a pre-tax basis. Okay? So what that means is that you will inevitably suffer a reduction in take-home pay as a result of increasing your contributions. The same applies for increasing your DPA, but probably not by as much as you fear. So what goes into retirement savings is going to be in excess of the reduction in take-home pay that you experience, basically because SARS is giving you tax relief on the additional contributions that are being made. Okay. And on the UCT HR website, there's a very useful cost of employment calculator in which you can very easily see for yourself the effects of increasing your DPA or increasing the additional contributions to the fund. So importantly, those changes in the tax regime from next year will limit the ability for high earners to make use of additional contributions, because there'll be an overall tax-free cap of 350,000 Rand per annum that can be paid into the retirement fund. Investment strategy I want to gloss over very briefly, because we will, as usual, have investment roadshows later in the year to help you make informed choices about, but I do just want to say a brief word about how you should be thinking about your investments leading up to retirement. And that is that those investments should not be independent of what you're planning to do with your money after retirement. You know, if you are 3 or 4 years away from retirement, you may not yet have thought about what you'd like to do with your money after retirement, but really you ought to start thinking about it. As you know, in the fund there are 4 funds from which you can choose, or you can be in what's known as the life stage model, which in fact is the default for members who don't exercise a choice. And thinking of the life stage model, which is instructive for those of you close to retirement, is that members are initially invested in the balanced fund, but in 5 years prior to retirement, a transition begins in which money is progressively transferred from the balanced fund to the income fund. And the reason for that is that as you get closer and closer to retirement, your ability to bear the investment risk that is associated with being in the balanced fund, which has a high exposure to the stock market, becomes less and less. Right? The member of the fund at age 30 who is subject to a loss of value of 20% of the stock market has many years in which to recover that downturn before retirement. If you're 63 and you suffer that, you obviously don't have the same ability to recover. So there is some merit in thinking about ensuring that you move towards something which effectively de-risks your portfolio. It takes away the investment risk that is associated with your investment choices. If you are thinking about being in a living annuity after retirement, you may well want to have some exposure to something like the balanced fund, in which case it's fine to remain exposed to the balanced fund pre-retirement. But if you're thinking about purchasing a life annuity, then something like the life stage model, where you move away from the balanced fund towards something that is less volatile, more secure, like the income fund, might well be in your best interests. And finally, the question of, well, why not retire early if I'm not on track? There are two forces that work in your favor by delaying your retirement. The first of them is obviously that you're going to be saving for a longer period of time. You're going to have more time in which to earn investment returns on your accumulated savings. So all things being equal, the cash amount that is available at retirement ought to be greater if you retire at 65 compared to retiring at 64 or 63, for example. But then in addition to that, with every year that you age, your life expectancy reduces a little bit. And that means that it becomes cheaper to purchase R1 of pension. So that R1 of annuity income that you purchase is going to cost you less rands at age 65 than it would have at age 60. The combined effect of those two forces is that you are very almost certain to have a higher retirement income by retiring later than retiring earlier. So if you find that you're not on track and you were previously considering retiring early, perhaps your first consideration would be thinking about delaying that retirement until normal retirement age. Okay. That's a brief rundown of the key issues for those of you not retiring at the end of this year. Does anybody in that group have any questions at this stage? Yes?
Are all these talks and all these slides available somewhere on the UCT website?
I'm certain that the slides will be available. I'm not sure if the talk itself is being recorded. Okay, so both will be available on the website, yes.
Is the life stage model not old-fashioned?
Old-fashioned in...
I mean, retirement now is sort of like 30 year plus. It's not short-term anymore.
It's... I'm not sure I'd use the term old-fashioned, but it's not necessarily appropriate if you are intending to invest in a living annuity after retirement and intending to maintain some degree of exposure to the markets. Then you have the problem that the life stage model is effectively removing you from the markets up to age 65, at which point you're suddenly going to reinvest in the markets. That exposes you to unnecessary risk. It's much better to have a sort of a smooth transition from where you are at age 60 to where you want to be at age 65. But it is very much the appropriate mechanism if you are planning to purchase a life annuity at age 65. Because the costs of those life annuities are not linked to movements in the market. So you run a very real risk of an underperformance in the market, which you can't recover in purchasing a life annuity. So it really depends on what you're intending to do after retirement, and that's those choices are what we're going to go on to now.
Just a practical question. Is one's own responsibility to keep track of the various tax carryovers that both you and Hugh refer to? You know, whether if you are in a few annuities and you get these credits up to a maximum of 350,000, or does HR keep you a little, from each individual, a little record of what you've taken?
The SARS have access to all.
Presumably on your e-filing thing, you can track it. So basically you have to track it yourself.
Well, for financial planning purposes, yes. I mean, it's incumbent on you to track it yourself. In terms of actually claiming that tax-free allowance, what will happen practically when you retire is that UCT HR will make the application to SARS, who will then aggregate it with all your other benefits, and will make sure that you're not claiming more than that 500,000 rand tax-free, for example. At the back.
Could I ask that you repeat the question? Some of us approaching retirement can't hear.
Yes. Okay, great.
I particularly like the question repeated because the answer sounded interesting.
Okay. The last question was, whose responsibility is it to keep track of an individual's various retirement savings, retirement annuity, different retirement funds, preservation funds, etc., for the purposes of aggregation and deciding on tax-free lump sums at retirement? And the answer is, for financial planning purposes, that's your responsibility with your financial advisors. But in terms of process at retirement, SARS will be doing the necessary checks to make sure you don't get away with things, if any of you had clever plans to do so. One more question, then we'll move on.
What's the procedure for taking early retirement?
Margie, can I hand that over to you?
Yes. Early retirement at UCT applies from age 55, so you can take early retirement. So for past staff, the application goes through your head of department and ED to the EDHR for approval, and for academic staff it goes through your head of department and dean to the DVC for approval. So you can contact HR if you...
Okay, and is approval, is that a given?
In most cases, yes.
Okay, I'm sure there are a few more questions, but just in the interest of making sure that we get through everything, can I ask that you hold those to the end of the session? Yes,
Can I
Margie.
qualify? Just say, Amos is a right, so approval is right.
Okay, let's move on then to the questions for those who are about to retire. And if you are a year or two away from retirement, this is not your cue to nod off, because really these are issues that you should be thinking about now already. The choices that you're going to have to make. Well, let's run through all of the benefits that are due to you and those where you have to make choices. But I'm going to be dwelling in particular on what is highlighted in bold here, which relates to your UCT RF benefits. This is a provident fund, so you may, as Mr. Amos said, take the money and run. This is not a course of, if there's any aspect on which I'm willing to be accused of giving financial advice today, I would suggest that that is not the right strategy, and you should be thinking long and hard about how much you need to take in cash, how much is appropriate to take in cash, and how much ought you to be holding back in order to secure some kind of an income that will provide for your retirement years. In addition to the UCT-RF benefits, from UCT you would receive accumulated leave pay, any benefits that may be due to you from deferred compensation policies, and also the post-retirement medical aid subsidy, which I'm going to assume everyone is familiar with, but I'm sure Margie will be happy to take questions on that at the end if indeed there are any. Another option that's available to you if there is you've identified a need to continue with life assurance cover after retirement, is that the separate group life assurance policy, the one that covers you for 1 times your DPA, has embedded in it a conversion option, which means that you can choose at retirement to convert the cover that you had under that policy to an individual life policy, and can do so without having to show to the insurer any evidence of health. And this is, if you are in poor health, something that you may wish to consider, or may be useful for estate planning purposes. So this could be used to cover the estate duty that will be due on the wind-up of your estate in the case of death after retirement. or for any other kind of capital injection. Perhaps you wish to leave an inheritance for dependents but don't wish to take out a living annuity. Well, this is an alternative way of achieving that. And then, of course, you may have a number of individual policies in your own name, which you should be thinking long and hard about. Preservation funds, retirement annuities, other deferred compensation policies, endowment policies, and other investments. But I want to focus particularly on the UCTRF benefits and on the choice that you face in terms of converting that lump sum that you're going to be entitled to at retirement into an income that's going to provide for your retirement years. So, first of all, just to reiterate that there is a tax-free lump sum available. So everybody is entitled to a tax-free lump sum up to 500,000 Rand. Plus, for those of you who transferred AIPF benefits into the UCT retirement fund, those AIPF benefits. And there is some sense in taking some of your benefits in cash, right? That 500,000 Rand is going to be available tax-free. Even if you wanted to convert all of that to an annuity, it would make sense, as you mentioned earlier, to do that in the form of a voluntary purchase annuity rather than leaving it as a compulsory purchase annuity. You may have some outstanding debt at retirement. So, for example, you had an outstanding 500,000 Rand mortgage bond. There might well be sense in taking that 500,000 Rand tax-free and using that to settle the debt. But the decision that you make about how much cash to take should not be taken in isolation of the question of how much income you're going to need, right? Remember that whatever you take in cash is money that is then not available to provide for annuity income. And that has got to be your primary consideration. The cash is not likely to last very long, but the rest of your lives in which you're going to need that income could last a very long time indeed. And how do you decide on the best option for you? I mean, really the choice is going to come down to living annuity or life annuity, which we'll look at the issues and pros and cons of each of those. But a useful mechanism for going about making this decision is a 6-step process, for which I thank Olivia. Step 1, asking yourself, what needs do you have at retirement? What are your expenses likely to be? What is the absolute minimum that you need to live on? What would you like to have in addition to that to have a comfortable retirement? What's going to cause you the greatest regret in retirement? So you may be tempted, for example, to invest in a living annuity which is exposed to a fund that has a very high exposure to the stock market because you believe that's going to give you the highest expected returns. But it's worthwhile asking, what are the risks associated with that? What regret will it cause me if I suffer a significant loss on those investments, which is of course possible? What regret will it cause me if I live to the age of 98 and am forced to live on the capital that remains at that point in time? Having answered those, what pension options are available? That we will unpack in a moment. And which of those pension options best meets my needs, as expressed in steps 1 and 2? What income is going to be secured by that option, and then within that optimizing tax position. But that's very, very much a subsidiary a consideration to the rest here. So as I said, in terms of establishing your retirement needs, you need to think of this on 2 levels. What are the expenses that you're likely to incur for your basic needs? Your expenses, conventional wisdom is that expenses are likely to fall after retirement. This again is a generalization. It's going to depend on individual circumstances. But all things being equal, if you have paid off your house by the time you retire, that expense falls away. You may have had children who are financially dependent on you who are no longer after retirement. If that's the case, those expenses fall away. There is an additional tax rebate for taxpayers over the age of 65, so your tax expenses ought to reduce. You don't need to travel into UCT every day, so perhaps your traveling costs will reduce. But this is very much a generalization. These criteria may not apply in your particular case. And there may very well be some categories of your expenditure that are likely to increase after retirement, of which medical expenses is probably the major consideration. Typical rule of thumb that experts in the industry use is that people should be aiming for a retirement income of 70 to 80% of their pre-retirement income, what the experts refer to as a replacement ratio. You may, in analysing where you're likely to end up, find that you fall short of this. And if so, believe me, you're in very good company. Data from Alexander Forbes suggests that the average replacement ratio in South Africa is in fact 29%, which implies some pretty significant lifestyle adjustments. This is the reason that financial advice is so important, because if you are in a situation where you're going to have a retirement income that is very much less than what you were earning pre-retirement, well, that's going to require either finding some alternative form of support, perhaps as a family that can support you, or perhaps you need to find an alternative source of income in retirement, and or some significant adjustments to your lifestyle, changes to your expenditure. That, I'm afraid, is the brutal reality if you find yourself in that position. So let's just illustrate that risk briefly by having a look at life expectancies. These are derived from the most recent set of annuitant mortality tables produced by the Actuarial Society of South Africa. And these tell us that if you're currently aged 60, you would expect, if you're a man, to live to 80, and if you're a woman, to live to 85. At 65, you'd expect to live to 82 or 86, respectively. And if you're currently 70, you would expect to live to 84 or 87. Medical technology continues to improve. Awareness of health and lifestyle continues to improve. And the net result is that life expectancies continue to increase. So I would expect if we revisit this in 5 years' time that those numbers are going to be even bigger. Okay? It's very tempting to have a look at that if you're planning to retire at 65. Say, well, as a man I expect to live to the age of 82. So I need to plan for my retirement capital to survive until the age of 82. Okay. So very quick reality check. If life expectancy is 82, what that means is that there's a 50% chance that you're in fact going to live longer than that. If you've planned for your retirement capital to last until 82, then on the toss of a coin, right, if that coin comes up heads, you may have insufficient money to provide for the rest of your life. I think you would have to be a particularly risk-seeking kind of individual to be comfortable with that. So if you're going to invest in something like a living annuity, where you're going to be subject to those risks of outliving your capital, you probably need to plan to live a lot longer than those life expectancies would suggest in order to feel comfortable with the choice that you've made. Okay, so I'm going to run very quickly through the aspects of life, key aspects of life annuities and living annuities. I think Hugh has given you a very good introduction to these, so I don't need to dwell on them too long. A life annuity is an insurance product. What you're doing is you are transferring risk from yourself to an insurer. And the key risks that are being transferred are, first of all, that risk of living too long. By purchasing a life annuity, you are guaranteed that you will be paid an income for the rest of your life, no matter how long that may be. Okay. You also transfer the investment risk. So you lose control over the investment of those assets. Those are handed over to the insurer. And in expected return terms, there is a price to be paid for that. But you pay that price because you are happy to pass over the investment risk. Okay. With the life annuity, there is an initial pension, and that is guaranteed for the rest of your life. You may also purchase the annuity with an escalation, in which case the pension is guaranteed to escalate at the predefined rate from year to year. You may, as an option, direct that the pension be continued to a spouse or a partner on your death. And importantly, you have no involvement in the management of those assets once you've made that selection. So if you purchase a life annuity at the age of 65, you are locked into that. There's no chance to revisit that decision. So it is one that needs to be taken after some very careful consideration, and probably in the light of professional financial advice. As I said, you can direct that the pension be continued to a spouse after your death. The most common levels at which that continuation would occur are either 50% or 75%. The higher the percentage you choose, obviously, the greater is the inheritability, if you like, of your pension, the degree to which it will outlive you and provide for your partner and dependents. But you pay a price for that in the form of a lower initial pension. You can also, as you mentioned earlier, select a guaranteed term. And just to re-emphasize the point, if there is a guaranteed term of 5 years in the annuity, what that really means is the annuity is guaranteed for 5 years or the rest of your life, whichever is the greater. So the 5-year guarantee doesn't in any sense mean that the life guarantee is removed. And what this does is provide you with some comfort about the preservation of some part of your retirement capital. If both you and your partner were to die in the first year of retirement, in the absence of a guarantee period, effectively that retirement capital is lost to the insurer. The insurer has made a profit on you, which in their minds will counterbalance the losses that they're going to make on your compatriot who lives to 101. But if you're concerned about that and want to make sure that there is something left for other dependents, you may wish to have a 5 or 10-year guarantee period associated with the pension. Sometimes pictures speak louder than words, so let me give an illustration of these effects. So let's assume that we have a pension which is payable on a single life basis. In other words, there's no continuation to the spouse, and there's no guarantee period, and it's taken out at age 60. And we have a male pensioner who survives until the life expectancy of 80. What will happen then is that the pension is paid between the ages of 60 and 80, and on the pensioner's death, that pension ceases. That's the top picture there. The first alternative scenario, what happens if that individual dies at the age of 64? Well, there is payment for those 4 years, but at the end of that, the balance of that money effectively accrues to the insurer. There's nothing further that's payable to the spouse or dependents. And that sounds like a particularly bad business deal to have entered into, but remember that that time of death is uncertain. If alternatively you live until 94, the insurer is going to be picking up the cost of that. Right? That additional strain, those extra years of payments effectively are being guaranteed by the insurer. If in addition we add a spouse's pension and a 10-year guarantee period, in the top picture, if the member dies at the age of 64, his wife dies at the age of 66, and there's a 10-year guarantee period. Well, there's a payment in full for 4 years of the pensioner's life. There's then a continuation payment to the spouse for the next 2 years of whatever continuing percentage has been selected. And then in addition, there are 4 years left of that 10-year guarantee period. So those additional 4 years continue to be paid to surviving dependents. In scenario 4, member dies at 64, there's a 70% spouse's pension, but no guarantee period. Well, then it just continues to the spouse, but subject to no guarantee. And in the final scenario, scenario 5, the pensioner dies at 64 with a 70% spouse's pension and a 10-year guarantee period. The pension is paid in full to the member for the 4 years. Then it continues to be paid in full to the spouse for the balance of the 10-year guarantee period. It does not reduce here because this has occurred within the guarantee period. So that full pension is guaranteed for the 10 years. And after age 70, given that the spouse has survived in this scenario, the pension continues to be paid to the spouse. I hope that exposition was clear, but happy to take any questions later provided. In addition to those options, the life annuities are delivered in a number of different ways, and the key distinction between them is the way in which they offer escalations. So the simplest of all is a level pension, where there's no escalation whatsoever in the amount of the monthly the pension over time. And that obviously means that the purchasing power of that pension is going to be eroded by inflation over the years. And if you survive for 30 or 35 years after retirement, the income that you're receiving in real terms at that point is going to be a very small fraction of what you started out with. You may, in addition, alternatively, select a pension which has a guaranteed rate of escalation, perhaps 3% or 5% per annum. A with profits pension, which you briefly introduced earlier, probably the most complicated of them, so I'll take a little bit of time to explain that. Or an inflation guaranteed pension, where the rate of escalation is not fixed in nominal terms, but is linked to the increase in the CPI, so that your pension should keep pace with inflation. You should preserve the purchasing power of your initial pension. So obviously with a level pension, you're exposed to the risk of inflation increasing. But even with a guaranteed level of escalation, even if that's at 3% or 5%, you are exposed to some degree of inflation risk. If inflation exceeds 5% and you have a 5% escalation, then over time, the real purchasing power of your pension is going to be eroded. You can protect against that by selecting an inflation guaranteed pension where the future pension increases are going to be equal to the rate of inflation. The price that you pay for that will give you the lowest initial pension of all of the options that we're considering here. Okay? And this makes the option appear expensive, but you need to bear in mind that this is the price that you're paying because the insurer has agreed to take on that inflation risk from you. Remember, that's one of the three key risks that you face in retirement. And if you transfer a risk to another party, you should expect that there will be some price to be paid for it. Financial advice will help you to determine whether that price is reasonable given your particular objectives. And then the final option is a with profits pension. So this is slightly more complicated, but the way that it works is that it is secured at a particular, what's known as a post-retirement interest rate. So let's say, for example, that is set at 5%. That means that the initial pension is secured on the assumption that the investments are going to earn 5% per annum into the future. Okay? Now, we actually expect that the investments are, over the long term, going to earn more than 5% per annum. And it's that excess over 5% that is going to provide for escalations on the pension. Right? So, what will happen on an annual basis is that the insurer will look at the actual investment returns on the underlying portfolio, compare those to the 5%, and then make a decision on how much of that can be used to support escalations. Does this mean that if the investments return 30% in 1 year, that you will get a 25% increase? No, it doesn't, because the insurer needs to hold back some of that, because in the following year, when the investments deliver minus 5%, well, they don't have the ability to give you a minus 10% increase, right? The rand value of your pension is guaranteed here. So those excess returns in good times are held back to supplement the losses that they will face by preserving the capital value of your pension when the returns are not so good. It is probably second to inflation-linked annuities in terms of protecting you from inflation risk, and is the investments underlying with profits pensions are likely to be a little more aggressive than those underlying inflation-linked annuities. So you might expect over the very long term that you would get better increases from a with profits pension than an inflation-linked pension, but that very much depends on what the actual investment returns turn out to be. And the big disadvantage is it's unpredictable. This is a hypothetical comparison of the four. So the horizontal purple line across the middle shows the income that you would earn from a level pension. So as you can see right at the start, that gives you the highest level of initial pension, but there are no escalations on that. So that stays the same in nominal terms throughout all of the years of retirement. Something with a 3% guaranteed increase, well, you get an initial pension that's a little bit lower, but after about 7 or 8 years that would catch up and then start to exceed the pension that you would have had on a level basis. With profits pension would start a little bit lower than that, but you would again expect over time that would deliver increases that are better than either of the preceding two. And an inflation-linked annuity would give you the lowest initial pension of all, but is guaranteed that it will keep pace with inflation. So if you expect to live reasonably long and you are concerned about preserving the purchasing power of your pension, you should certainly include inflation-linked annuities and with-profits annuities in the range of choices that you consider for your provision of your retirement income.
Those figures, are those based on real figures that last graph?
Not real historical figures. That's based on a hypothetical case where, where there's sort of a constant investment return and inflation from year to year. One of the things that a financial advisor could do for you is to show you the pension increase history of different with-profits providers against inflation, for example, to help you make a more informed call. So that in a nutshell is life annuities. Okay, so the key component of life annuities is that there is this transfer of what we call the longevity risk, the risk of living too long, and possibly a transfer of all or some of the inflation risk and investment risk in addition. Your other alternative is a living annuity. What must be made clear is that a living annuity is not, like a life annuity, an insurance product. It is in fact an investment product. And the way it works is very simple. You have an opening retirement balance on which you earn an investment return, and that investment return is determined by the choice that you make about the portfolios in which your retirement capital is invested. You then also make a choice about the rate at which you are going to draw down on those investments, and what emerges at the end is simply the sum of those. Right? Your initial capital plus what you've earned by way of investment return, less what you've taken by way of drawdown income, and that is your closing balance in each year. You have a couple of options. You can go out to the market and purchase a living annuity from what is known as a LISP. That's not a speech impediment. That stands for Linked Investment Service Provider, does it? Yeah. So these are financial services organizations which offer platforms which allow you to invest in the portfolios of a range of different investment managers. Or alternatively, you have the option to take a living annuity within the UCT retirement fund. And I'll talk a little bit about the many pros and few cons of that choice relative to going to the commercial market. The key features of a living annuity are, number one, and this is quite an attractive feature for many of you, you retain investment control. You decide how those assets are going to be invested. This is somewhere where you can and indeed should take investment advice. And you also decide on your drawdown rate. And you have a choice, by the way, about the frequency of payments. So you can take a living annuity payment monthly, quarterly, semi-annually, or annually in arrears. So that means that it's payable at the end of the month, end of the quarter, end of the year. So if you choose annual payments, for example, your first payment would be 31st of December in the year after you retire. You couldn't move that forward. If you need money before that, you would need to choose a higher frequency of payment. SARS puts in place the limits of drawdown. Basically, you must take out at least 2.5% of your opening balance in any year, and you may not take out more than 17.5% of your balance. In addition, within the UCT retirement fund, the fund's actuary will place a maximum on the amount that you can take out. This is not a hard and fast constraint. You can sign a form to say that I have, I'm conscious of the risks, but I wish to take out more than this within the SARS limits. But it is a very strong recommendation not to take out more than that. And as we said earlier, we in general don't feel that members retiring at 65 should initially draw down anything more than 5% of their living annuity balances. That investment strategy and drawdown is not something that's cast in stone forever, so you can review that on an annual basis. Income continues to your spouse and dependents in the event of your death, probably the most attractive feature of a living annuity is that when you and your spouse have both passed away, there is a remaining part of retirement capital which is then can be passed on in the form of inheritance to other dependents. But the key feature here is that you are effectively taking on that risk of living too long. If investment returns are poor, if you draw down too much, or crucially, if you live too long, you will find that a living annuity cannot provide adequately for your income in later years. It's also the case that living annuities typically have a higher cost structure than life annuities because there is the need for ongoing advice in the review of investments and drawdowns. The administration of them is more complex than the payment of a simple living annuity. All of those contribute to higher cost structures. The UCTRF living annuity, by contrast, is quite cost effective, and I'll show you an illustration of that in just a moment. And whereas with a life annuity, you are locked in once you've made that decision, with a living annuity, you can actually review that at any time. And before the age of 75, it's relatively easy to switch from a living annuity to a life annuity. So we think one of the key value propositions of living annuities is for members who are retiring from the UCT Retirement Fund, but in fact intend to continue working in some capacity, earning other income, where it would make sense to invest in a living annuity, to draw down the absolute minimum, and then at the point when that full retirement kicks in, to consider converting the remaining capital to a life annuity. So this is not an easy choice to make. As you've seen, there's numerous pros and cons, but if your primary concern is providing a sustainable inflation-linked income for the rest of your life, then life annuities are very likely to be a better bet than living annuities, simply because of the benefits of mortality pooling. The fact that the insurer is grouping together a bunch of people, some of whom it knows are going to die earlier than expected, where it will profit from the money that it's taken in relative to what it's had to pay out, that it then used to subsidize those who live longer than expected. And you'd expect a living annuity to keep pace with a life annuity for some perhaps considerable length of time into retirement, but there must come a point at which you start to reach that 17.5% cap on what you can draw down, and from that point onwards living annuities tend to deliver reducing levels of income. So this is something on which you should take financial advice and should think very carefully. The advantages of a life annuity: you have the peace of mind that longevity risk has been transferred. If you choose escalations, particularly inflation-linked escalations, you have that protection of the real value, the real purchasing power of your pension. But you do lose control over your investments, and once you make the choice, you are locked into it. You have limited ability to pass on an inheritance, although you can counteract that, for example, with a long guarantee period. But I think the real question that should be posed is the point of your retirement savings to leave an inheritance for dependents, or is it not to provide an income for you in the course of your retirement years? And that transfer of longevity risk, well, it brings peace of mind, but it does come at a price. You are going to be paying a price for that in the form of a lower initial pension. Living annuity, on the other hand, has tremendous flexibility to meet your individual needs in retirement. You can choose investments, you can choose the rate of drawdown. You have more control over what gets left by way of an inheritance. As I said, we think it's very useful as a temporary measure if you're going to be earning some income after retirement, and it's clearly useful for members who are in ill health, where if you go and purchase a life annuity, you're effectively going to be priced on the same basis as the rest of the population. In other words, on the assumption that you are in regular health. So if you expect to live considerably less than your peers, a living annuity may very well make sense for you. The biggest con is that there is a very serious risk of outliving your retirement capital, and that's something that you need to go into with eyes wide open. There's a need for ongoing financial advice as far as investment strategy and drawdown is concerned, unless you are sufficiently financially sophisticated to be able to make those decisions yourself. But the key point is that those decisions have to be made on an annual basis. Now, at the age of 65, I'm sure you all feel quite capable of engaging mentally with the decisions that have to be made and making informed choices. But a key question to ask yourself is, do you expect at the age of 95 to be able to make those informed choices? If the answer to that is no, well, there's perhaps a risk, a long-term risk involved with the living annuity strategy. And living annuities, particularly those purchased in the commercial market, tend to have high commissions, high advice fees, and high management fees associated with them. So let's just quickly have a look at costs. Now, costs will not be the only criterion on which you make a living annuity choice. Right? There are many other things to decide, but costs are going to be one of the key features that you need to take into account. And you would face some initial costs, so that the LISP would have an initial upfront fee. If you are using a financial advisor and he or she is remunerated on a commission basis, there would be an initial commission payable for it. On an ongoing basis, the LISP offers an administration fee. There would be portfolio management fees of the investment manager, perhaps an ongoing advice fee for your financial advisor. There would be transaction costs involved anytime you want to switch investment. And the bottom line is that living annuities from LISPs are generally more costly than those from the UCT retirement fund. Now, there may be reasons relating to your individual preferences as to why you would prefer to go to a commercial provider rather than a UCT retirement fund. One of those, for example, would be the range of investment options available. Perhaps you don't want to be constrained by what's in the UCT retirement fund and would prefer to have the vast range that's available from one of the commercial providers. And that is a valid reason. But you should do this in the light of this comparison of costs. I won't run through the detail here, but let's just look at the bottom line for somebody retiring with 500,000 Rand in a living annuity. Under the UCTRF, there would be an initial fee of 400 Rand, and then a total fee of about 340 Rand per annum. For the best case commercial provider that we could find, the comparative fees are 5,000 Rand initially and 3,125 Rand per annum on an ongoing basis. So those are fairly significant differences and something that you should take into account. And if you are taking financial advice on this and seriously considering a living annuity, make sure that your financial advisor properly considers the UCTRF as one of your options. There's a need for ongoing financial advice as far as investment strategy and drawdown is concerned, unless you are sufficiently financially sophisticated to be able to make those decisions yourself. But the key point is that those decisions have to be made on an annual basis. Now, at the age of 65, I'm sure you all feel quite capable of engaging mentally with the decisions that have to be made and making informed choices. But a key question to ask yourself is, do you expect at the age of 95 to be able to make those informed choices? If the answer to that is no, well, there's perhaps a risk, a long-term risk involved with the living annuity strategy. And living annuities, particularly those purchased in the commercial market, tend to have high commissions, high advice fees, and high management fees associated with them. So let's quickly have a look at costs. Now, costs will not be the only criterion on which you make a living annuity choice. Right? There are many other things to decide, but costs are going to be one of the key features that you need to take into account. And you would face some initial costs, so that the LISP would have an initial upfront fee. If you are using a financial advisor and he or she is remunerated on a commission basis, there would be an initial commission payable for it. On an ongoing basis, the LISP offers an administration fee. There would be portfolio management fees of the investment manager, perhaps an ongoing advice fee for your financial advisor. There would be transaction costs involved anytime you want to switch investment portfolios. And the bottom line is that living annuities from LISPs are generally more costly than those from the UCT retirement fund. Now, there may be reasons relating to your individual preferences as to why you would prefer to go to a commercial provider rather than a UCT retirement fund. One of those, for example, would be the range of investment options available. Perhaps you don't want to be constrained by what's in the UCT retirement fund and would prefer to have the vast range that's available from one of the commercial providers. And that is a valid reason, but you should do this in the light of this comparison of costs. I won't run through the detail here, but let's just look at the bottom line for somebody retiring with 500,000 Rand in a living annuity. Under the UCTRF, there would be an initial fee of 400 Rand, and then a total fee of about 340 Rand per annum. For the best case commercial provider that we could find, The comparative fees are 5,000 Rand initially and 3,125 Rand per annum on an ongoing basis. So those are fairly significant differences and something that you should take into account. And if you are taking financial advice on this and seriously considering a living annuity, make sure that your financial advisor properly considers the UCTRF as one of your options. Okay? A major warning sign should be if the UCTRF is simply discounted as a possibility by your financial advisor.
Sorry, may I ask, if you double the amount that you're putting to $1 million, would that 5,000 Rand double as well? Or
if you double, the question was if you doubled the amounts to $1 million, would those fees double? I think I'm right in saying that on the UCTRF they would not. Right, those would remain the same. On the initial fee for the retail provider, the initial fee would double. That tends to be a percentage of assets. There might be a sliding scale, so it might not be quite a proportionate increase, but it would certainly increase beyond the 5,000 Rand. And on the ongoing fees, given that scale of fees, it wouldn't quite double, again, because you've got that sliding scale, but it would certainly be more than the 3,000 Rand per annum. Yeah. So we've selected the 5,000 Rand, in fact, deliberately to show a picture that is not as unfavorable to the commercial provider as would be the case if we had chosen, say, 3 million. A question at the back?
I would just like to find out if we do decide to leave our money with the UCT retirement fund, do you have financial advisors who we pay them for the appointment, or how does that work?
The question was, does the UCTRF have financial advisors? And the answer to that is no. So UCTRF neither employs financial advisors nor does it recommend financial advisors. What we will be doing with the document that those of you about to retire will be receiving very shortly is providing you with some pointers on how to go about finding a financial advisor, the questions to ask your financial advisor to ensure that you are getting impartial advice. But that is fundamentally an individual responsibility. Who would you like to add to that?
Yes, I would like to add to that, because if you're in the UCTRF as a living annuitant, there is no ongoing fee to anybody. And that is one of the pitfalls which you need to watch for, because a financial advisor gets nothing if they're on a commission basis, if you stay in the UCT retirement fund. So if a financial advisor is advising you to go into a living annuity and to go elsewhere, is that financial advisor asking you to do so because that financial advisor gets this, or because it's in your interests? It may be in your interests, but think about it.
Those figures you're is that likely to increase over the years?
I would imagine that it would increase broadly in line with inflation, but I would not expect it
wouldn't meet the commercial.
No, the benefit of the fund is that we benefit from economies of scale. We have existing arrangements with investment managers, etc. So there's no risk that will inflate anywhere like the fees that we see here. At the back and then down here.
I came in slightly late, so I might have missed something. UCT at one stage indicated that they were considering setting up a life annuity. Is that still in the works, or?
It is impractical for a fund to set up a life annuity that involves making choices about a preferred provider to whom we commit members. So what we have done, rather than set up a fund life annuity, as those of you who are going to be receiving these retirement quote documents shortly will see, is that we have gone to the insurer market. We've identified for each category of annuity, with profits annuities, for inflation-linked annuities, etc., who are the 2 or 3 major players in those markets, and we will be sourcing quotes from each of those providers so that you can make an informed choice about what is best for you. And we think that's in members' interests, that in the sense that you then benefit from competition in the market rather than us committing to a particular provider. The fund doesn't have the resources to take on the risks of providing an annuity, so we'd always have to outsource that to an insurer. Then there was a question down here.
A couple of questions. Can one hedge one's bets by, say, putting 50% into a living annuity and 50% into a life annuity?
Yes. Short answer.
The second thing is a comment. I mean, I spoke at length to a financial advisor who told me flat out you can't get a living annuity through UCT, and clearly the fact that their commission was going to be hit. I mean, it involved correspondence with Olivia and sort of saying to them, actually, this is possible, and they were, very distraught at the thought. That, so I think, the point about just being very careful about who's interested in it. But the one thing I don't think you've done, and I can just ask you, you haven't talked about the cost on the life annuity, because often there seems to be quite a hefty percentage that's being paid to the advisor or commission, and that cost is not shown, but it is also a significant cost in your life annuity.
It may very well be, but the annuity quotes, the life annuity quotes that you as a UCTRF member will be receiving will be entirely commission free. So if you choose to interact with a financial advisor and he or she wishes to recommend another annuity for you that has 1% of the value built in as a commission, once again that's reason to question their impartiality. I think if you have a good financial advisor, they would probably say you should take advantage of this commission-free offer. What I would like to do is to charge you 3,000 Rand for advice relating to this, and I honestly believe that is. My guess is that in 20 years' time, this industry is going to look completely different, and that fee-for-service is going to be the dominant mode of delivery. Commissions are largely going to be a thing of the past because they have these perverse incentives built into them.
Both the living annuity and the life, is it possible to top up the pension which is existing in the UCT or retirement fund with pre-tax income? I mean, it's tax income.
To my knowledge, there is no way of achieving that. No.
Can any of the money currently in the UCT retirement fund be used if one decided to go for a living annuity through UCT? Or I've got pension money from 20 years working elsewhere that's invested somewhere else. Can that be put together with this or not? If I did decide to go for that option.
Okay. Is that to do with the pension versus provident funds?
It's one of the pension fund reforms that's rooted, but it's not yet possible.
Can we remind you to repeat the question? It can't be heard.
Apologies. The question was, if one has accrued retirement savings in another vehicle, another retirement fund, preservation fund, etc., is it possible to aggregate those, to bring those into the UCT retirement fund and to purchase one UCTRF living annuity? The answer to which is, as things currently stand, no. It's not. It is not possible.
Can I follow that to the question relating to something you've been saying? He talks about people having put their ARPF funds into the UCT retirement fund. But those of us who put them into other preservation funds, can we move them into the UCT retirement fund now?
No, that ship has sailed, I'm afraid. And you still benefit from the tax-free nature of them, I think. That's,
the point about converting a living to a life annuity, can that be done you said up till age 75? Is that a recommendation?
I don't think that is a... So the question was the taking out a living annuity and then converting that to a life annuity at a later stage. I said that's easy to do up to age 75, and the question is that a hard and fast cutoff? I don't think it is, but most insurers are reluctant to quote for annuity business past age 75, but by the time you all hit age 75, survival past 100 is probably going to be so common that the rules will have changed.
And can the spouse do that on behalf of the person who made annuities originally settled?
In the event of your predeceasing your spouse, yes, indeed, yeah. Spouse retains full control of the living annuity.
And I'd like Margie to tell us about the medical aid subsidy.
Yeah.
Because
That's the actual policy if you look at the bottom. So for staff who were employed before June 2000, the entitlement of the post-retirement medical aid subsidy is being restricted. So staff appointed after 2000, it's restricted to an accrual of 2% per annum up to a maximum of 50%. But if you're appointed pre-June 2000, what you will receive, and I think most of UCT staff are on the Coastal Saver, it's 50% of the Coastal Saver, that's the current medical aid subsidy. So I think for a single person it's about 750 Rand a month. I think for a partner and spouse it's about 1,200 Rand at the moment. And it goes to council each year with the Discovery Health increases for approval in terms of the increases for that year. And if you do have dependents now, the subsidy does go up at 50% up until the dependents are 21 years of age. So after that date, it accrues at 2% per annum. So if you've been here for 10 years, then it will be 2 times 10, which is yeah. So you'll get 20. So you'll need to stay here for 25 years to accrue the 50%.
I see a lot of questions. I just want to, I have a few more slides, but I think what I'd like to do is just actually conclude with one of those and then take whatever questions you have. And that's just a list of considerations for circumstances in which living annuities and life annuities respectively make sense. So you should consider a living annuity if you have sufficient or more than sufficient capital at retirement and you value flexibility. You are either very financially sophisticated yourself or you have access to skilled and independent advice. You have a very strong bequest motive. You want to leave a financial inheritance when you die. You want to be involved in decision making during retirement, and importantly not just in the first few years of retirement but on an ongoing basis throughout your retirement. Or if perhaps you're in ill health and have a life expectancy of less than 15 years, it would make sense to consider a living annuity. On the other hand, a life annuity is likely to come to the top of the pile if it's very important to you to have a known guaranteed income in retirement where you don't take on investment risk. You don't particularly want to run the risk of outliving your capital. You're either not married, don't have dependents, or don't have a particularly strong bequest motive. So your retirement capital is first and foremost about providing an income for you and perhaps close dependents. You wish to benefit from the benefits that come from mortality pooling. And finally, if you expect to live into a riper old age, you should be very cautious about living annuities, and life annuities should be high on your list of considerations. So I think let me conclude on that and then use the 10 minutes that we have left to take your questions. So I think can we start? There's one in the middle here, and then we'll go to the top left.
The $500,000 that is available as tax-free money, is that cast in stone, that value and the time of retirement? Should you say want to take 300, for whatever reason, take 350,000 of that on retirement because you know of another 150 coming up that you want specifically to take in 3 years' time, can you take that 150 as tax-free in 3 years' time?
I'm going to defer on this to my learned colleagues because I'm afraid I don't know the answer.
Could you ask Jennifer Rowefeldt?
I thought you, yeah.
The present answer is no, but that may change. The SARS will give you that benefit the first time round. But that may change.
Thank you.
You said you can't aggregate your funds and put them into the UCT. What does that mean mechanically? If you've got accrued funds from other pensions, or say you've got unit trusts, and you want to get everything into a living annuity, does that mean you must take separate living annuities, one with UCT and one with this?
Well, that would be one option that's available to you. Or alternatively, you could, of course, aggregate all of those with one list. And the decision between those two is going to take into account how important it is to you to have everything under one roof, and also relative costs between the two vehicles. But unfortunately, consolidation of all of those in the UCTRF is not currently possible. Yes.
If you took a living annuity from UCT, would you have different, like a conservative portfolio, a balanced portfolio, a depressive portfolio that you could, or have you just got one thing that got
So the question relates to investment choices under the UCTRF living annuity, and the answer to that is that the investment channels are exactly the same as those that are available to you currently. So the 4 funds, A, B, C, and D, the income fund, the smooth bonus fund, the balanced fund, and the Sharia fund. All things being equal, as you age, you would probably be well advised to move to more conservative investments, but the building blocks are exactly the same. And then there's a follow-up.
Can you split it? Can you put half into a life annuity and half into a living annuity?
Yes, you can. Very, very easy to do that. And I don't know if you chose to do that, to put half into a life annuity and half into a living annuity. One of the things that you might consider is at a later stage transforming that living annuity into a life annuity. Olivia and Hugh, do you know whether one could top up the existing annuity with an insurer, or you'd have to purchase a separate annuity if you did that? Same insurer, right, okay. Yes?
When you mentioned that isn't up there, is if you want to carry on working for a few years, and mention the benefit of a living annuity. And the big difficulty I see is knowing when you're 60 what you're going to do when you're 65. And not only whether you want to, whether options will be available. And that seems to me quite a difficult decision to make a few years before. Does one take a conservative option or
So the question relates to my exhortation that those a few years away from retirement should already be thinking about what they want to do post-retirement. And that is a very difficult question because you don't know what options will be available to you in terms of continuing working opportunities, etc. And that, unfortunately, is the reality. It is an unknown. It is a difficult decision to make, but that doesn't remove the need to make it. It's the same as making an investment strategy decision. How do you allocate your retirement fund investments now? It's a very, very difficult decision to decide what is in line with your objectives, your risk profile. It's a question that almost all of us, in fact, I go so far as to say all of us are ill-equipped to make, but yet we have to make that decision. So really, I guess what you have to do is, so what are the possibilities and what are the implications of the various decisions I may take if each of those possibilities transpires, and possibly take professional financial advice on it. There's a question just behind.
Yeah, if you don't take your tax-free amount and leave it in your living annuity and just take a drawdown, will your income tax be reduced, and how do you work out how much it will be reduced?
And the question is, if you do not take a tax-free lump sum, you leave all of that in a living annuity and you draw down. Again, I'm going to have to lean on advice here, but my understanding is that there is no tax benefit from doing so. So in other words, if you want to benefit from that tax-free, you would need to actually take it out. There's a solid reason in that case for taking the tax-free lump sum and possibly a voluntary purchase annuity or using that to settle debt. Okay, a question over here.
This is a very specific question, so I don't know if you can give any advice.
A very specific question. A financial advisor has said, take all your money and put it in retail bonds. Can you make any comment on that?
For me to answer that question would probably run foul of my prohibition on giving investment advice, but I would say be cautious of the motives of that financial advisor. It's about as close as I can get to answering your question directly.
Is the subsidy only available if you've got a coastal plan?
No. The level of the subsidy is pegged to the coastal saver, but it applies regardless of which plan you've selected.
Europe and the UK, their retirement age has been the ceiling has been lifted. Is there anything on the cards that might happen in South Africa?
So the question was that in Europe and the UK, the state pension age, the age at which national retirement benefits kick in, has been progressively lifted over the last few years. Is anything on the cards in South Africa? Well, there's a broad range of retirement reforms that are being considered by Treasury. They haven't, as far as I know, broached directly the retirement age question yet. As most of you know, this has been an issue for UCT over the last year or so. And my personal opinion is that with increases in life expectancy, it's just impossible for us to retain 65 as the default age at which people retire. And I'm sure there will be upward pressure on that, but as to the timing of that, I have no particular insight or opinion. Yes?
Can you withdraw from the fund, that lump sum? Can you do it at a later, or do you have to do
it? That is the question is, can one withdraw the tax-free lump sum at a later date? And the answer is no. You need to make a decision at retirement and decide what you're taking in cash and what you're going to convert to an annuity.
The 500,000 rand, in that, does one have to, can one include any leave pay that's outstanding? In other words, if one has leave pay which is going to be paid out, is that taxable or not taxable? Can be built into the 500,000 rand non-taxable amount?
Currently for gratuities at retirement such as leave pay, Rowena, looking at Rowena up there, will ask retirees whether they would like us to ask SARS for a directive for the leave pay to be tax-free. So then by the time it gets through to summum for the balance, then the balance would also apply. So your leave pay would be, you could get a directive for it not to be taxed, or you could have it taxed and have the full 500,000 from the retirement fund.
Okay,
so you need
basically it would be within
the
500,000
total. Yeah. So it's one of the decisions you will.
Okay, thank you very much, ladies and gentlemen.